Good afternoon. This is the Cow Guy Close. I am wearing my tie. I got my pin on, but I am not the Cow Guy. I'm Dan Geltrude, also known as America's Accountant. I'm filling in for Scott, who will be back tomorrow. One question people always ask me is whether the stock market is going to go up or down. My answer is always the same, and it's one word. Yes, it's going to go up and it's going to go down. So it's about timing. So let me be clear. I can't time the market. No one can. Success in the market comes down to strategy and playing the long game. I don't provide advice about specific investments. What I do tell people is that investment diversity based upon achieving reasonable outcomes is a wise strategy. Now, let me use a baseball analogy here. Focus on singles and doubles. Bunt when you need to, hit the sacrifice fly too. You'll occasionally get that triple as well as the home run. But when you swing for the fences every time, you'll end up striking out a lot. So bat for a good average. In baseball, success 3 out of 10 times will get you into the Hall of Fame. In the stock market, you could do much better than that with the right strategy. Our first guest is in my Hall of Fame. Please welcome Keith Fitz-Gerald, principal of Fitz-Gerald Group. Keith, I want to hear your strategies on where we go from here. A lot of craziness going on in the market. What say you, my friend?
Well, I tell you what, you raise a very important point, one that we talk about constantly with our folks. You've got to play the long game if you want to win the long game. Pessimists make money at moments in time, but optimists, people who are playing the long game, make money consistently at long periods over time. Markets like this come and go, Dan. They go up and down. That's entirely normal. People forget that success, by its very definition, includes failure. So the fact that they're selling and buying is exactly what you want to see. It doesn't feel good. It's scary. The headlines are making you go crazy. They make my head explode, frankly. But if you stick to the very best names, the very best companies making products and services the world cannot live without, guess what? That's where your RBIs are going to come from, particularly if they pay dividends. Those stocks fall less, stabilize first, and recover fastest, which is why I don't fear big down days.
So when you're looking at this, Keith, I mean, short term, long term. So do you have some specific plays that you say, all right, this is short term versus this is long term? Or do you just say everything is long term? How do you play that? And what do you tell investors specifically about that?
Well, you want to be able to be nimble and you want to take those opportunities when you can see it. If you've got that Sunday pitch and you can hit out of the park, then take the dang thing. For example, Tesla in early 2012, people looked at Elon Musk like he was a raving lunatic. I saw something brilliant. The stock's up 8,000% and something like that in the last decade. So you do get those things. There's 8 to 10 Teslas out there right now. People think the end of the financial universe is upon us, but look at yourself. Is Apple really going to go out of business? I think the answer is no. If Tesla is really going to go out of business, no. But both of those companies are being priced that way right now. The stock market is really weird, Dan. It's the only place in the world where you can have a 50% off sale and people run the other direction.
Well, you know what? That is really I'm going to steal that, by the way, if you don't mind, Keith. But you're
Sure.
Exactly right. So people who were loving Apple 12 months ago, where's the love now? Or 18 months ago? If that stock is down and you loved it then, what's going on now? So I really think that's tremendous advice. But that goes to the long game, right? Because if you like Apple, then you stick with Apple. But that leads me to this. What about big tech in general? How do you see that, Keith?
Well, people are making a tremendous mistake right now. They're saying, oh, big tech is terrible. Big tech is going to go out of existence. No, it's not. You've got to understand that not all big tech is the same. For example, Apple. People are changing the way they buy. They're changing their medicine. Inflation rages. They're worried about recession. I haven't met one person yet that's giving up their iPhone because of inflation. In fact, people are buying it more because it helps them do more in their lives. On the other hand, you've got something like Peloton. iPads on a bike are not a business no matter what anybody says. It's no wonder this stock has failed. So I would submit, if you've got a short-term opportunity to buy Apple on sale and take money that otherwise would have left you holding the bag at Peloton, maybe that's a good trade. So there is very much short-term opportunity, even if you have a long-term perspective.
I mean, speaking of Peloton, what I think about is the trajectory of that company during the pandemic, right? Because people couldn't get out to the gym. Not that I was getting out to the gym before that. That's another story. But everybody could work out at home. Now, once everything opens back up, where's Peloton now? Are there other companies that you see that are going to have those similar types of problems?
Oh yeah, the market. Here's the thing, people again, they just get this short-term angst and their emotions run wild, which is why they can't play the long game. They lack the long-term perspective to overcome the short-term chaos. So if you look at a stock like Carvana, for example, or even a household name like Meta, I submit that's a $50 stock because Zuckerberg is having his, handed to him by Cook, who is now in the driver's seat. And the fact that Musk is out with his new AI and his chatbots, that's got to be terrifying to Zuckerberg. So, that's an example of a household name that I think is destined for some seriously rough times.
What do you make of these layoffs and big numbers? What do you think of that?
Two things. Number one, I think Powell is as wrong about labor as he was about transitory. So the fact that there are layoffs does not disturb the case for example, high tech. They used to have three job applicants for every opening. Now they've got 2. Hiring continues. The composition is simply changing. We're becoming a nation of service and hospitality providers as opposed to high tech brain power. Now that, good or bad, is just simply what's happening. So I look at that market. I say, layoffs are a sign of prudent management. The companies that are doing that, cutting hard, cutting fast, I'm going to take a hard look because if they got good numbers in a business case, guess what? I still want in. But if they're just laying people off for the heck of it, or management has no idea what they're doing, and you're getting the dog ate my homework on the earnings call, I'm not interested.
Well, I think that's an excellent analysis, Keith, and we appreciate that insight. So thank you so much.
Thanks, Dan.
I want to take a minute to tell you all how touched I am by your positive feedback. We got quite a few messages on our text line, so let's dial up the cow phone. One viewer writes, "Are you kidding me? In my day, you got a job and paid for school, work nights or whatever. I'm tired of paying everyone's way." This viewer is referring to our segment with Rebecca Walzer on student loan forgiveness. Many of us remember those days well. Back then, a part-time job was 36 hours a week with no benefits. You worked a shift that didn't interfere with your class load, and some days you were on the go for 16 hours at a time, maybe more. From Dan in South Dakota, great job. Thanks for the compliment, Dan. I believe this is the same Dan who told Scott yesterday that smart people are in South Dakota too. We're going to have Scott add Nutley, New Jersey to that list as well. And Mike, Minnesota, asks, "Dan, if inflation slows and wages stay high, jobs are going to be replaced with robotic technology and overseas labor, and unemployment can skyrocket in a couple of years. This is the formula for a depression, right?" Mike, thanks for the question. I would hesitate on using the word depression. We are seeing robotics and overseas outsourcing. I can tell you on a personal level, this is out of necessity and not always choice. The workers simply aren't there. Regardless of what the labor market tells us, down the road, this could impact the unemployment rate. But I hesitate to use the word depression. Well, we'll hear more from viewers later in the show. Every year, fitness is the #1 New Year's resolution. And every year, most gyms clear out by March. But if the US dollar is a gym rat, he's still going strong. Easy there, buddy. Strong isn't always good. The always buff Bill Baruch is up next to help me explain when Cow Guy Close returns. Many people may think a strong dollar is a good thing. Why wouldn't they? We want a strong country, so it would seem that we would also want a strong dollar. Well, this is not like going to the gym where getting stronger is always positive. It's a little bit more complicated than that. And no, this is not footage of the cow guy lifting weights back in his college days. A strong dollar makes American-made products more expensive for other countries to buy. This can hurt the bottom line and the stock value of companies that operate internationally. To help us understand what is happening with the dollar is Dollar Bill Baruch, president of Blue Line Futures and Blue Line Capital. Welcome, Dollar Bill. So, Bill, listen, there's a lot of people out there thinking just what I said. Strong dollar, that's great. What say you?
Yeah, thanks, Dan. Thanks for having me on today. Really excited to be here joining you. Dollar higher is really going to hold back a lot of international trade. And that's something you want to think about. So these multinational companies that are located in the U.S., the easiest way to think about it is foreigners are going to be able to buy less of their products. And that's really something to think about there, as well as, if you're a farmer, you're a producer, and you're exporting, it's the foreign currencies, those currencies abroad go farther against don't go as far against the U.S. dollar, with the dollar stronger. So that's really something to think about. But the dollar's come in quite a bit here in recent weeks.
So Bill, what exactly is behind making the dollar strong? I mean, what causes the situation that we're in right now?
Well, it all starts with the Fed tightening monetary policy, got the year going and the dollar strengthening. But when you look at the energy crisis that's taking place in Europe, they're going to have this crisis that's slowing growth. It hasn't been as bad as some would have thought, but it slows growth there, which weakens the euro. And really every currency, it's not its own asset. It's trading against a currency somewhere else. So the euro is weakening, the dollar strengthening against the euro. And again, you get a crisis like that's taking place there. It's slowing growth, continues to weaken the euro, while domestically here, the Federal Reserve is tightening policy. Growth really hasn't been that slow in the U.S., and the data has been fairly positive so far. You're going to get a stronger dollar, and the U.S. dollars continue to strengthen. But in recent weeks, it's come in because they're talking about the Federal Reserve slowing the pace of rate hikes, and slowing the pace of rate hikes, that starts to get calibrated in the market and getting priced in. So we've seen the U.S. dollar come in quite a bit recently, but it's at a big support level.
So when we're talking about the dollar strengthening, right, and in this particular case, because we have the Fed raising interest rates in order to fight inflation, so it's really inflation that's somewhat behind this move on the dollar, correct?
Yeah, absolutely. I mean, as inflation picks up, I mean, the Federal Reserve is balancing their monetary policy with that in mind. As inflation picks up too, it's a tailwind to the dollar. It's a tailwind to rates, and when rates domestically, U.S. Treasuries, when those rates are higher, it underpins a stronger dollar.
So if we talk about our friends in agriculture, right, the farmers, this creates a problem for them, right? Because everything that our farmers are going to be exporting with the backdrop of a strong dollar is going to hurt them.
Yeah, absolutely. So, guys, I was saying earlier, the foreign currencies are going to go less far against a stronger dollar. So they're purchasing less agriculture products, less grain products, because if they're going to purchase a notional amount, then now that amount is going to cost more. So it's going to go less against the stronger U.S. dollar. So when they're exporting these grains, it's going to the orders are going to be potentially significantly less. That's something to think about.
Some people may think, well, no. This is good for agriculture because people have to buy it, and therefore our farmers will actually make more. That's actually not the case. What you do have is a retraction of those purchases. So our people in agriculture are absolutely being hurt by what's going on.
Yeah, I mean, it's one way to look at it. Is if the dollar continues to rise. I mean, again, we had a pullback here, pretty significant in the recent weeks. But as the dollar continues to rise, it's going to create some issues. I mean, it slows growth around the world in that sense. And they're going to be ordering again less grain. It's going to slow, basically slower for farmers who export. But there is some bright spots here, and I would say again that even though the U.S. dollar is at support as well, the Treasury market's at resistance, meaning the yield market the yields inversely are at support. We could see the dollar rebound, and I'm not expecting a slow start to next year. I'm not expecting a recession. So if the data continues to be pretty steady, and we're seeing growth here in the U.S., it's going to continue to underpin a firm dollar. It's going to continue to kind of bring a tailwind to steady rate hikes from the Fed. So we're not out of the woods, even though the dollars pull back. And there's something to kind of really watch here in the coming weeks, coming months. But one thing I think is important is China, which is a massive importer of U.S. agriculture products. The Chinese yuan is back below, or the U.S. dollar is back below 7 against the Chinese yuan. So again, even though the U.S. dollar has broadly been strengthening, the yuan is rebounding right now, and that's something that be a near-term tailwind for farmers.
Well, that is excellent information right there, people, from Bill Baruch. Thank you so much, Bill.
Thank you.
We talk a lot on this show about inflation and how it's touching everything, which means it's become sticky. And it's about as stuck as this portly pooch trying to get back in. I think I have one simple solution that would get us unstuck. Carley Garner's up next to help me sort it all out when Cal Guy Close returns. Scott and I often say that the inflation problem is being driven by a lack of supply. Demand is there, but supply is not. Specifically, we need to increase the supply of energy. Energy is power, no pun intended. However, whoever has more energy wins. It's that simple. But there are a lot of people, powerful people, that want to get rid of fossil fuels altogether when we don't have a replacement. That's not smart. I also believe it's a threat to our national security. We need an expert to tell me what I'm missing here. Please welcome our resident queen of crude, Carley Garner of DeCarley Trading. Carley, I'll start by saying that I heard a rumor that today may be your birthday. Is that true?
You heard right. 29. Just kidding.
Happy birthday. Happy 29th birthday. So glad to have you on the show. So let's talk about this. We can just get rid of fossil fuels at this point. We're done. We have electric cars and we're good to go, right? Am I missing something?
Yeah, I mean, you're not missing anything, but I think society in general might be. So I heard your segment earlier with Keith talking about the long game. Well, the energy market is no exception to the long game. The transition to something other than fossil fuels to maybe something a little cleaner or maybe even cheaper and more efficient is a long game. It's something that's going to take decades, not months or years, and we can't force the process. It's going to take technology, advances in technology, and that only occurs by making mistakes and learning from them and moving on. So at this point, we need fossil fuels to help us in that transition. In other words, fossil fuels are not the enemy. They're actually our solution to getting to where we want to be at some point in the future. I mean, I don't know where the renewable industry is going to take us. I don't think anybody does. But the idea is if there is a way that we can get to a point, and I'm not saying we can, but maybe we can get to a point where we can produce enough energy to run our households and our businesses without any expense other than the equipment, I think we should absolutely explore that. But it's something that's going to take a long, long time. And in the meantime, we need fossil fuels to help us get there.
Well, that's the whole point. I think there's so many people out there trying to rush this transition, and it just can't be that way. You know, I have a question for you related to oil. So as oil, the price per barrel starts coming down, and people always ask the same question, well, why am I not seeing that at the pump?
Well, I mean, you have to keep in mind the price of oil is not what we put in our cars. It has to be refined, and then the gasoline we put in our cars. And there's a process of refining, but also capacity and storing and things like that. So in other words, by the gas station that you're getting your gas from has already locked in prices and purchased that gasoline months prior. So it's not like it's something that happens overnight. And also, I mean, just like anything else in the economy, prices go up a lot faster than they go down because there's a lot of hands in the cookie jar. So there's that sort of thing going as well. And we have to keep in mind, anybody that's involved in the oil industry, whether they're a producer or they're gasoline refiner, or maybe they're even a gas station owner, there's a lot of risk. I know we take it for granted and we try to say that people are gouging us, but the reality is there are years where these businesses and entities lose a lot of money because the price of oil is very volatile. And if they're not hedging efficiently, or maybe even if they overhedge, they can get themselves into trouble really quickly. It's a really dangerous market and a dangerous industry for everybody involved, including the consumer.
You know, Carly, we only have about 15 seconds, but I just want to ask you something. Why do we see the price of fuel coming down, but not the price of diesel? What's the difference there?
The reality is there's a shortage of diesel refineries, and so there's all types of supply demand issues going on there. And the reality is most of the supplies that we enjoy on a day-to-day basis are brought to us by diesel trucks, cargo trucks. So the demand for diesel doesn't really go down while the demand for gasoline goes down when the economy softens up. So it's a little bit different dynamic. But in the long run, money always talks, supply always comes in commodities when prices are high. We've seen that even in the diesel market. Things are softening despite the horrific supply-demand situation.
Well, thank you so much for that, Carly, and happy birthday.
Thank you.
Before I sign off for the last time, let's see some more of your texts as we dial up the cow phone. From Seymour Clearly in Colorado. Could that really be his name? Dear Dan, love your tie. If this Econ News deal flops for you and Scott, there's a bright future selling merchandise. Ozzy and other 70s retread rock stars would surely buy a cow guy guitar played by Garth worth $1 million at auctions. I'm not sure the world is ready for a venture like that from the cow guy and America's accountant. Another viewer writes, good job, Danny Boy. Now, I got to tell you, people who call me Danny or Danny Boy usually have known me for a long time. I don't know if that's the case here. Great questions for your guests. Really liked how you got Rebecca wound up. The tie was a nice touch. This viewer is referring to my toss to Rebecca when I told her to convince me that student loan forgiveness is a good thing. That was a tongue-in-cheek comment. We all know Rebecca's thoughts on this subject from a legal and moral perspective. Well, that was fun and insightful segment with Rebecca. And finally, he did a great job. Great tie to this one is signed by our friend, Scott Shellady. Even on assignment, Scott is still on his A game. Thank you for watching, my friend. Scott's back tomorrow, and I know he'll love to hear from you. Shoot him a text. There's the number on the screen. Make sure you leave your name and state, and please don't hold back. Well, guys, or the herd, as Scott calls you, it's been a lot of fun the last 2 days. I want to thank you for letting me into your homes this week. Don't forget, you can check me out on dangeltrude.com. Thank you. Bye-bye.